What if the biggest investing mistake is not losing money, but believing you are smarter, safer, and more prepared than you actually are? Because every year, millions of people enter the world of investing with excitement, confidence, and dreams of financial freedom. They open an app, watch a few videos, see stories of ordinary people turning small amounts of money into massive wealth. And suddenly the market starts to feel easy. It starts to feel predictable. It starts to feel like everyone else is getting rich except them. And that is usually the exact moment where the biggest mistake begins, because investing is not just about money, it is about emotion, patience, fear, ego, temptation, and human psychology. And the people who fail are often not the people with the least intelligence. They are usually the people who underestimate how emotional money can become when real risk enters the picture. Because when markets rise, almost everyone feels like a genius. Almost every decision looks smart. Almost every investment feels unstoppable. But when reality changes, when prices begin falling, when panic spreads across headlines, when influencers suddenly disappear, when losses become real numbers on a screen, that is when people finally understand that investing is not a game. It is one of the greatest emotional tests a human being can face. And today on Careful Click, we are going deep into the biggest mistake new investors make, the silent mistake that destroys savings, creates regret, and traps millions of people in cycles of fear and disappointment. And if you stay until the end of this video, you may completely change the way you think about money, wealth, and investing forever. So before we continue, take 1 second to subscribe to Careful Click. Give this video a thumbs up, leave a comment telling us what first inspired you to invest, and share this video with someone who wants to build wealth wisely, because financial education can save people years of pain, stress, and expensive mistakes. And remember, this video is strictly for educational and informational purposes only. We are not financial advisors. We do not guarantee profits, and every investment decision should be made carefully after doing your own research. Because in the modern world, many people are entering the market for the wrong reasons. They are not investing because they understand businesses, economics, or long-term wealth building. They are investing because they are afraid of being left behind. And fear of missing out has become one of the strongest emotional forces in modern finance, especially in the age of social media, where success is constantly displayed, but failure is often hidden, because people love posting screenshots of profits, luxury lifestyles, expensive vacations, and fast gains. But very few people show the sleepless nights, the losses, the debt, the stress, and the emotional damage that often comes before those moments, and new investors absorb this illusion every single day without realizing it. They begin believing that investing is supposed to feel exciting all the time. They begin chasing speed instead of stability. They start confusing gambling with investing. And slowly they stop focusing on long-term wealth and begin focusing only on quick money. And that is where the biggest mistake starts growing quietly in the background. Because the biggest mistake new investors make is not starting too late. It is not starting with little money, and it is not lacking complicated knowledge. The biggest mistake is investing emotionally instead of logically, because emotional investing destroys discipline. Emotional investing creates panic decisions. Emotional investing makes people buy high and sell low. Emotional investing convinces people that temporary trends are permanent opportunities. And history has shown this pattern again and again for generations. During stock market booms, people feel unstoppable. During cryptocurrency surges, people believe prices will rise forever. During real estate bubbles, people think homes can never lose value. And every time human emotion repeats the same cycle, excitement becomes greed, greed becomes recklessness, recklessness becomes panic, and panic becomes regret because most people do not prepare emotionally for what investing really feels like. They imagine profits, but they rarely imagine uncertainty, and uncertainty changes people in ways they never expected because it is easy to say you can handle risk when markets are calm, but it becomes very different when your savings suddenly drop by 20%, 30%, or even more. And that emotional pressure pushes many new investors into terrible decisions because fear is one of the strongest forces in human behavior. Fear can make intelligent people act irrationally. Fear can make long-term investors suddenly abandon their plans overnight. Fear can turn temporary market movements into emotional emergencies. And sadly, many people sell during the worst possible moments, not because they lacked intelligence, but because they lacked emotional preparation, because investing successfully is often less about predicting markets and more about controlling yourself. And that is something many people never hear before entering the financial world, because online investing culture often focuses on excitement instead of discipline. It focuses on speed instead of patience. It focuses on luxury instead of consistency. And new investors begin believing that success comes from finding the next explosive opportunity instead of building strong habits over time. But some of the wealthiest investors in history built their fortunes slowly, patiently, and carefully because they understood something powerful. They understood that wealth is usually built through consistency, discipline, and time, not through emotional reactions and desperate shortcuts. And time is one of the most misunderstood forces in investing because people naturally underestimate how powerful small, consistent growth can become over long periods. Many people want massive results immediately, but real investing often rewards patience more than excitement. And this becomes difficult in a world where attention spans are shrinking and instant gratification is everywhere because modern technology trains people to expect fast rewards, fast entertainment, fast success, and fast money. But investing does not always work that way. Sometimes markets move slowly. Sometimes progress feels invisible. Sometimes nothing exciting happens for months or even years, and emotionally impatient investors often quit before the real benefits begin appearing because they mistake slow progress for failure. And this leads many people into another dangerous mistake, constantly chasing trends, because trend chasing creates emotional investing behavior. People see something rising quickly, they become excited. They buy late, they expect endless growth. And then reality eventually arrives because no asset rises forever. No trend remains unstoppable forever. And markets have a long history of humbling people who believe excitement alone creates value. Because when emotions control investing decisions, logic usually disappears quietly in the background, and many people never realize how much human psychology influences financial markets. Because markets are not driven only by numbers, they are driven by millions of emotional decisions happening every single day. Hope, fear, greed, panic, confidence, uncertainty, all of these emotions shape the movement of money around the world, and new investors who ignore psychology often end up becoming victims of it because they believe investing is purely mathematical, when in reality it is deeply emotional. And understanding your own emotions may become more valuable than understanding hundreds of complicated charts, because one calm decision during a difficult market period can sometimes protect years of hard-earned savings. And this is why discipline matters so much, because discipline protects investors from themselves. Discipline creates structure during emotional moments. Discipline helps people avoid impulsive decisions. And discipline reminds people that short-term noise does not always reflect long-term reality, because financial markets have survived wars, recessions, political crises, banking collapses, inflation scares, technology crashes, housing crashes, and global uncertainty for generations. Yet long-term investing has continued rewarding patient people who understood that temporary fear does not always define the future. And one of the biggest problems for new investors is that they often confuse information with wisdom, because modern investors have access to endless information every day: news alerts, influencers' predictions, opinions, rumors, financial entertainment, social media trends, market panic, economic headlines, all arriving nonstop every hour. And this flood of information can create emotional exhaustion because many people begin reacting emotionally to every headline they see. Every market movement starts feeling urgent. Every prediction starts feeling dangerous. And eventually people stop investing strategically and start investing emotionally based on noise. And noise is one of the biggest enemies of long-term investing because not every market movement requires action. Not every headline deserves panic. And not every opportunity is truly an opportunity, because sometimes the smartest financial decision is patience. And patience can feel uncomfortable in a world addicted to constant action, because human beings naturally feel like doing something is always better than doing nothing. But investing does not always reward constant movement. Sometimes overreacting creates more damage than temporary market declines themselves. And this is why many experienced investors focus heavily on risk management instead of excitement, because protecting money is just as important as growing it. And new investors often ignore risk because optimism feels more exciting than caution. But history repeatedly shows that markets can become unpredictable very quickly. And people who ignore risk often learn painful lessons when conditions suddenly change. Because economic cycles affect everyone eventually. Inflation rises, interest rates change, businesses struggle, unemployment increases, consumer behavior shifts, and financial systems constantly evolve. And successful investors understand that uncertainty is normal. They do not expect markets to move upward perfectly forever. They prepare mentally for difficult periods instead of pretending they will never happen, because preparation reduces emotional panic when challenges arrive. And emotional preparation is something many people never develop before risking real money, because they focus only on profit potential without understanding emotional consequences. And this can become dangerous, especially for people investing money they cannot emotionally afford to lose. Because once survival emotions become connected to investing decisions, logic becomes extremely difficult to maintain. And this is why responsible investing matters, because investing should improve long-term financial stability, not destroy peace of mind. And one of the most overlooked truths about investing is that mental health and financial decisions are often deeply connected, because constant stress, panic, and obsession can damage judgment over time. And many people become emotionally trapped watching prices every hour, refreshing apps constantly, comparing themselves to others constantly, and slowly allowing investing to control their emotions instead of supporting their future goals. And comparison is another dangerous trap for new investors, because social media makes people feel behind even when they are making reasonable progress. People see others claiming huge profits, huge portfolios, huge wins, and suddenly their own steady progress feels small. But comparison often creates reckless behavior, because people stop following their own financial plans and start chasing someone else's results. And that usually increases emotional risk dramatically, because every investor has different circumstances, different income levels, different responsibilities, different timelines, and different risk tolerance. And successful investing is rarely about copying strangers blindly. It is about understanding your own goals clearly, because financial success without emotional stability can become extremely destructive. And many people who appear wealthy online may be carrying enormous stress behind the scenes, enormous debt, enormous pressure or enormous uncertainty, because appearances can be misleading, especially online. And one of the healthiest things new investors can learn is humility, because humility keeps people careful. Humility reduces reckless confidence. Humility encourages learning. And humility reminds investors that markets can surprise anyone at any time, no matter how experienced they are, because even professional investors sometimes make mistakes. Even experts experience losses, and no strategy guarantees perfect success forever, which is why emotional control matters so much more than pretending to be perfect, because long-term investing is often about surviving mistakes instead of avoiding every mistake completely. And this changes the entire mindset around money, because instead of chasing perfection, smart investors focus on consistency, learning, discipline, and adaptation, because financial education is not about becoming fearless. It is about becoming more aware, more prepared, and more responsible with decisions. And that awareness becomes increasingly valuable in a world filled with financial distractions, manipulative marketing, fake investment promises, unrealistic expectations, and emotional pressure everywhere online. Because many industries profit from emotional behavior. They profit when people panic. They profit when people chase trends. They profit when people act impulsively, and emotionally reactive investors often become easy targets for misinformation and financial traps, which is why critical thinking matters more than ever before, because not every opportunity is genuine, not every influencer is trustworthy, and not every success story reveals the full truth behind the scenes. And sometimes the smartest thing an investor can say is, "I do not fully understand this yet," because patience and caution can protect people from enormous losses. And learning slowly is often safer than rushing blindly into decisions based on emotion, because wealth building is usually a marathon, not a sprint. And the people who survive financially for decades are often not the loudest people online. They are usually the calmest, most disciplined, and most patient people behind the scenes, because sustainable wealth rarely depends on emotional excitement. It depends on habits repeated consistently over time. And this lesson becomes even more important during difficult economic periods, because challenging markets reveal the difference between emotional investing and disciplined investing. And while panic spreads rapidly during uncertainty, disciplined investors often focus on long-term fundamentals instead of short-term fear, because they understand something many new investors forget. Markets move in cycles, emotions move in cycles, fear moves in cycles, but emotional decisions made during panic can create permanent consequences. And this is why self-control may be one of the greatest financial skills a person can develop, because controlling emotions during uncertainty is extremely difficult, yet extremely valuable. And in many ways, investing becomes a reflection of human behavior itself, because money amplifies emotion, money exposes fear, money reveals patience levels, and money tests discipline constantly. And the biggest mistake new investors make is not simply losing money. It is allowing emotions to control decisions without realizing it. Because once emotions take control, people stop following plans, stop thinking long-term, stop evaluating risk properly, and start reacting impulsively to every market movement around them. And over time, this emotional instability destroys confidence, creates stress, and damages financial growth. But the good news is that emotional investing can be improved with awareness, education, discipline, patience, and realistic expectations, because no investor becomes perfect overnight, and every experienced investor was once a beginner trying to understand uncertainty for the first time. And learning from mistakes is part of the process, but avoiding emotional decisions can save years of regret, because investing should never feel like gambling with your future. It should feel like building your future carefully, one step at a time. And that is why education matters so much, because informed investors are usually calmer investors, patient investors, and more disciplined investors. And if this video helped you think differently about money, investing, and emotional decision making, subscribe to Careful Click right now. Give this video a thumbs up, leave a comment sharing the biggest investing lesson you have ever learned, and share this video with someone who wants to grow financially without falling into emotional traps, because sometimes one important lesson can completely change a person's future. And always remember, the goal is not just making money. The goal is building a smarter, calmer, and more secure financial life. And in a world full of noise, pressure, fear, and distractions, sometimes the most powerful thing you can do is slow down, think clearly, stay disciplined, and always click carefully.